What's going on, guys? Today, I want to talk about something pretty simple. I want to talk about why I have this up in the background, but really just like some of the hard facts of like what I hear when it comes to investing overall and starting to get your money right? Most people never invest because they feel like they don't make enough. And that's kind of part of the trap. That's where the people who have the money want to keep you. They want you to stay out of the market so they can reap the rewards. The issue is if you don't invest, you get stuck with just losing money overall because of time. You have inflation, you have lifestyle creep because the prices of things are going up, because the dollar value is going down. Any year loss is going to end up hurting you in the long run. So the younger you are, the better off you are. But the best time to start is going to be today. The next thing here is DCAing. Everyone I ever talk to says that they want a dollar cost average into something. And if you want to keep it very simple, sure. Go ahead and dollar cost average. Then you have people who say, oh, you can't time the markets. You can't. You can't. This is true. But if you look at historical trends and you learn how to read a graph, or should I say a chart, you can tend to get an idea of when the likelihood of something dropping is going to be. And that's a big part of this. And then there's a few other things I want to touch on. But the first thing I want to look at is like why DCAing is bad, right? If you are not focusing on your money, you're making a mistake. If you're not intentional with your money, you are making your mistake. If you're living passively with your money, you are making a mistake. And this is what most people do. Because they think, I'll just be fine. And the next thing you know, you're 70 years old and you don't have enough money in your retirement account, right? So I want to look at some of the history here just real quick. So I have the SPY up here, Standard & Poor. S&P is pretty basic for how people tend to track things over time. And I want to show you just a few little like things you could do if you were really just wanted to go all in at specific times. And I think the biggest thing for people, if they really wanted to time something, is to look for elections, right? So this past election, what happened? Trump won, market tanked. Trump broke the market. No, this happens practically every single time a president wins. And the new year at the start starts out in a crapshoot. So I want to go back here, right? Let's go all the way back down here to 2008, right? Pre-crash. Right? We had, I believe 08 was what? This was the first term for Obama, right? He comes in, we have the crash. Obama wins. This market is tanking, right? Yeah, but the mortgage, yeah, that was a big part of it, right? Right into March. This market just took a major dump by 50%. What happens if you got in during this dump, this is when most people are running from the markets, which is a big problem. You should be buying when these situations happen. And that's a big reason why a lot of people don't make a ton of money investing. But if you just got in anywhere in this range between like December to March, you were just like, you know what, I'm going to invest. What happened? We went from 66 all the way up to the middle of 2010 to 120. So we doubled back up to 120 before we had a bit of a correction. So this was just a straight run, just straight gains for months into 2010. Right, coming off that awful prime mortgage bust, right? If we come down here, we're now in 2010, so 2008. Let's go to 2012, right? We're going to trudge along. Market's just going, still crawling. So if you went up here, you were making pretty good gains all the way up here. You almost doubled your money with most likely whatever you're in if you're in the right stuff. And then 2012 comes along, and we're trudging along. And then we had the election. Right? Same president. Obama wins again, but we have a correction. Right? We drop a bit. We drop about 10%. It's not as drastic. It doesn't tend to happen as drastic when you have the same president standing, right? I'm going to stretch this graph out just to show you a little bit. So now we're at 2012. So let's go up. 2016, right? You'll notice if you just invested right when this bottomed out, all the way up to 2015, we were practically running up the entire time. Were there drops and moments where we based around for a bit? Yes. But if you just went in here And notice that we were in a bull run, which we were. This is a bull run. We have higher lows, higher highs every single time, right? So we trudge all the way up until about 2015. Not bad. Then we get a decent correction, which again is par for the course. And then we start basing around here for a period of time until we run up until late 2016, right? We start to top out going into 2016, which makes sense, right? Things start to come down. We dip a bit going into November of 2016. And then for the first time in this presidential run, if you were just looking at elections, when Trump comes in 2016, we see a pump up, right? And we ride this all the way to 2018. Notice this is just running. You're just buying when the market pulls back 10 to 15%, which is rare. If you look at the historical times of like SPY, it's very rare they have a red year. So if you just look for that moment where that market drops off, you're going to most likely be good. So we run all the way up. Again, we get to 2018, we pull back again, end of 2018. Look at this. We're going to drop about 20%. It's all good, right? This is going to bounce right back up. We're going up even higher. Look at this. We go from 236 to 337. That's almost a 50% pump, right? We're at around 40% from this drop off. And then what happens here? We have an election. Again, you'll notice there's only really one election, which was when Trump first won, where there wasn't some sort of like big shift in the dip. Like this one wasn't as bad, right? So you really just got to look at the markers, right? So we come into 2020, and look at that fall off when Biden came in. And I don't care what side you're on here. This don't matter. Biden comes in, we retract, right? Look at this. We're down to 214 at launch. Now I know you can say this was COVID too. It's irrelevant. President comes in, 335 to 219, right? That's a 33% drop. And then what happens? We are off to the races until the end of 2021. Again, March-ish, after the election, right? Same thing. 2016, right around March-ish, after the election, we're going up. Again, pump, pump, pump. This is where we go into that little bit of a recession, where we kind of bounce around early January 2022 to early 2024. And like, if you just waited for this, you picked up here, you were still positive coming up here. And then we went down in late 2022 when things started to tank. Crapshoot, right? So what happens? We come back up. We're ripping, right? And then we literally rip. After this downtime into 2022, we rip from this moment until we start to see the next election, right? So the next election was what, November 2024, right? And we dip down. You'll notice there's just a secular trend of whenever you are around election time, things rip back and they bounce back. And look at this fall off again. We peaked out at about a little over 600 here, 612. We dropped down to 480, which I think was a huge, was that like 15, 20% drop at that point for these numbers? And then what happened? We bottomed out. My friends are calling, oh my God, the world is ending. Family, oh my God, we're going into depression. Everything's going. And I'm not saying we're not going, who knows really ultimately, but if you bought when everyone was scared again, we have ripped up another almost 25% since that point. As you can see here, as we went from 481 to about 593. So don't tell me you can't look at trends and statistics. If you really want to get good with your money, you can look at this and you can break this down into different time frames. And when we are in a bull run, we're still ripping up here. Like there's nothing here saying we're not. We're still going up. This line is still here. And I can bring this line all the way back. And you can just see the trend of where it touches. These are high, like there's a trend, right? So higher lows. And if I go up here, we got higher highs. This is the point, right? this is what you are looking for. Yes, you might lose money in some different terms, and for brief amounts of time, your accounts might go down, but that doesn't mean you need to panic. You should be always teeing up money on the side to hopefully get into the market, right? So, moral of the story here is like this thing, the S&P is always going up. Perpetually, it just keeps going up for the time being, and it has not shown a sign of slowing down. I'll talk about these indicators on another video. But the real thing here is this is why I tend to leer on the side of DCA, because I know when I go into individual stocks, they're going to find and have a similar pattern. Like IREN, which I'm very, very bullish on. You can see I was tracking this one because this was running for a good period of time in an uptrend, posting, what I was saying, higher lows, higher highs. It was great, but then the trend broke, which is why you see this fib over here. Let me get rid of this. You can see it broke. It broke the trend line, and this is when I was like, oh, cool. I'm going to buy. And I got in here, and now I'm reaping the rewards because it's been ripping back up. I bought a bunch around 5 and 6, and now it's up at about 9.12. So there's a patience in this trend, but if I was watching the bull trend, I could see where it peaks. And you can see this indicator does a good job of letting you know when there's a good chance it's going to pull back. But if I see this top right here at 8, I can see the reversal. I can see this start to trend back. It bounces down. Look at that. That's a huge fallback. 8 to 280. And then it does again. So, but it's still in that upward trend despite that pullback, right? Because it was down at $1. Oh, how I wish I could have been buying this at $1. But needless to say, same concept. There's always moments where stocks pull back. People don't think it's going to happen. Every single stock goes through it. Every bull run almost gets retraced at some point, and that start of the bull run becomes the bottom at a later point. It doesn't matter what stock you even look at. It's almost all going to do it over a period of time. Apple's another one. Look at this. We're going up, 180. We're pulling back. We're going up. We're pulling back. We're going up. We're pulling back. It's the same thing. You'll notice it starts to replace each other as you go, as new supports and resistances are established. I'm not saying you might ever see a 120 again, but there's a good chance you'll see a 170, and we did. And this was last seen in April of 2024. So it's just a matter of being patient. If you've seen upward trend, there's a good chance there will be a pullback based off the mark that you are currently looking at. The odds are pretty good, and this is why I lean toward just watching a chart over waiting for a DCA and just putting $100 in every single week. It's a lazy way to do things. If it works for you and it's getting you to invest, I'm not telling you to not do it, but it's something to be aware of. If you learn basics and you learn to follow trends and learn to follow where markets are going and do basic fundamental analysis and macro trends to see what industries are currently working and doing well, you follow those charts, you follow those stocks, and you make a move when the time is right. AMD's a really big one, but I'm digressing now. I could talk about this for a while. So every few years, the market's going to drop 20 to 30%, and that's really the message I'm trying to get across here. That's when you want to take a look. Same thing here. You can see AMD broke this track. This is where I was looking to buy. If you look at any chart over the last 10, 20, 30 years, you will see this, and this is how I prepare. So you should always have a position of cash just building. You should have your savings, and you should have, this is my future investment fund. This is going into the market when I know the timing is right for the stocks that I monitor. But I don't care if you don't have time. You make the time. If you want your money to work for you, you make the time. But you can't make money investing. Yes, you can. You just have to put the time into it. Like anything else that we do, it's going to take time and you getting involved with what it is you're trying to accomplish so you learn it better and you make better moves over time. Because trust me, I still make stupid moves. I lose money all the time because I like to trade options. That's that gambler in me that comes into play. But I've gotten a lot better of not going in as big, following charts and catching mini moves and then taking cash out when the time comes, right? So waiting till you have money is it's like waiting to get fit before you hit the gym. You need to get in and you need to dedicate the time and you need to get better. You need to invest intentionally and do the things that you need to do. Otherwise, you're never going to see the results that you are looking for, right? It's not that you need more money right now. You need to put a plan aside to get what it is you are trying to get done and achieve those goals that you want to get to, which I think for most of us, We would love to see our investment accounts grow to the area that we really want them to get to, so we feel more secure in our life, which is a whole different conversation, right? So this is just a message I wanted to get across today. I hope you guys take a little bit away from it. Trust me, it takes a lot to get this stuff down. It takes a lot of practice, and I've taken my fair share of stupid losses because I get in my own way as well. And I can tell you, once you put a system in place where you're just watching and being patient and buying when the time is right, like here and here and here, you'll be much better off as long as you're looking at companies that are of quality, they're in the market, and they're trending the right way. Sounds complicated. It's really not. Happy to do another video on some of this, but for now, I'll see you guys in the next one.